I'm Cynthia from Empower to Free, and in this video, we will be looking at the investment marketplace. Similar to a physical market, there are buyers and sellers in this marketplace. For each product and its variation, there are investors and traders ready to buy and sell. If you are unsure of the difference between investors and traders, check out our other video on the basics of investments. Now back to this. Unlike a physical marketplace with different stalls selling identical products, an investment marketplace has just one stall where all the buyers and sellers of everything come together. What you will get to see is the prices that people are looking to buy and sell at and their respective quantities. The key here to making a match is therefore the price and volume. Say, for example, you are looking to buy 10 bottles of almond milk at $2 each, and there are no other buyers fighting with you. If there are two buyers out there, one selling 5 bottles for $3 each, and the other selling 3 bottles at $2 each, you can definitely get at least 3 bottles from the second seller. However, you would either need to increase your offer to $3 each to get the other 5 bottles available, or wait for the price to drop. Even then, you will still have a shortage of 2 bottles. You may then need to increase your buying price to attract more sellers into the marketplace. As long as a match exists, you can buy or sell your desired item for your set price and quantity. If not, you will either have to wait or adjust your price to better your chances of finding a match. Imagine a marketplace where everyone is shouting their selling or buying price and quantity. Isn't that chaotic? Because it is so messy, meet the modern day investment matchmakers. These are the brokerage or trading houses. For a commission fee, they help collate prices to facilitate a match. The other key players in the marketplace are the product producer and the government. The producers in our analogy are those who create products for the marketplace. Without them, nothing exists for the buy-sell to happen. In the investment marketplace, these are the listed companies or fund houses who create the investment products. The government polices the marketplace to make sure that everyone plays within the rules. They bring order and confidence that this is a safe place to make transactions. Now, to put it all together, the marketplace activity is driven by the people who buy and sell. We have investors, traders, and speculators. Some are individuals while others may represent organizations. They all have their own priorities and interests. The interaction between all players influence the price and quantity movements for the various products. When we think about the number of people involved in the investment marketplace, it is thus challenging to accurately know how prices and quantities will move. As everyone has a different role and priorities, each person's behavior will vary and may be hard to predict. This adds another element of uncertainty, which is why people can feel that the investment world is dangerous. Even with lots of psychology or human behavior research, it is almost impossible to predict how people will behave. This is why it is important to factor in uncertainty in your investment actions. Can you wait it out until prices improve? Or are you prepared to lose if you cannot wait? With some planning, we can all benefit from investing and handle the risk that comes with it. Now that we have reached the end of this video, we hope that you have an idea of the basics of investments. If you'd like to learn more, check out our digital course available. Remember, you can make informed and confident money decisions. See you in our next video.